Okay. So this is our question. Have you done any of these questions?
So 1 minute. No, sir. I did the balance sheet only.
Okay. So let's solve this question. First of all, question number 23. Actually, there is tax information, so we will solve question number. Prepare a common size statement of profit and loss from the following statement of profit and loss. Okay, income is given, revenue from operation 14 lakh, 16 lakh, purchase of stock in trade 9 lakh, 10 lakh, and change in inventory of stock in trade 1 lakh, 1,80,000, finance cost 80,000, 80,000, other expenses 90,000 and 1 lakh 30,000. Total expenses is 11 lakh 70,000 in year one, and in year two it is 13 lakh 90,000. Profit before tax and tax is deducted from the profit before tax, and profit after tax is given. So first of all, which year is current year and which year is previous year, there is no consideration for this information because we don't need to compare these two. Okay, we are not preparing comparative statement. We have to do the separate interest, percentage calculation for each year. So there is no consideration of previous year or current year. Now, the first year, actually, if I prepare the format, it will take some more time here. But if I prepare this, okay, then, the format is already given. There is no change in the format. So it will be easy for us to solve here. So first, the base item in the statement of profit and loss is revenue from operation. So both of them is 100%. Yes.
Yes, sir.
Okay. After that, the purchase of a stock in trade. Actually, we have to do some calculation. No, let us solve this question in OneNote. So first of all, heading common size statement of profit and loss. For the year ended 31st March 2000. There is no information about year, so leave this. Generally, we write the latest year, that is current year and date. Okay. Note number current year 1 amount, year 2 amount. Now this column is for common size percentage. And this is year 1, and this is year 2. Now, the first item is revenue from operation. And the amount of revenue from operation is 14 lakh, 16 lakh. The second item is, no, it is third item, expenses. The second is total revenue. It is equal because there is no other income. So 14 lakh and 16 lakh. After that, expenses, purchase of stock in trade, then change in inventory, inventory of the stock in. After that, finance cost and other expenses. Then total expenses, profit before tax, minus tax, and profit after tax. Okay, so revenue from operation, we have already written this, 9 lakh, 10 lakh, purchase of stock in trade. After that, 1 lakh, 1,80,000. $80,000, finance cost, 90,000 and 1,30,000. Total expenses, 11,70,000 and 13,90,000. After this, 2,30,000 and 2,10,000. This is our profit before tax. And 40,000, 30,000, 36,000 is tax. And in the last, 1,90,000 is profit after tax. And here it is 1,74,000. So this is our statement of profit and loss. Now, after this, we have to calculate the percentage. So this will be 100% because the base item in a statement of profit and loss is revenue from operation. So if there is no other income, then your total revenue is also equals to revenue from operation. That's why it is also 100%. Now, purchase of stock in trade. So we have to do working note for calculation of all the common size percentage. You will write heading common size percentage, and then you will calculate percentage for FD item, like purchase of stock in trade. Purchase of stock in trade. So first is 9 lakh in first year, and year 2 it is 10 lakh divided by the 14 lakh and 16 lakh. Into 100, and here into 100. Okay. So this is our first item. Second is put change in stock in, change in inventory. So it is 1 lakh, 1,80,000, 1 lakh divided by 14 lakh into 100. And 1,80,000 divided by 16 lakh into 100. Okay, so like this we have to calculate our percentage. Now for calculation of percentage, it is 9 lakh okay. So the first is 64%. It is 64.28%. So 1 lakh divided by 14 lakh, it is 7.14%. 80,000 divided by 14 lakh, so it is 5.71, and 90,000 divided by 14 lakh, it is 6.43%. Okay, so this is our percentage. Now 11,70,000 divided by 14 lakh, it is 83.57%. 2,30,000 divided by 14 lakh, it is 16.43%. 40,000, it will be 2.86%, and 1,90,000 divided by 14 lakh, it is 13.57%. The next is year 2, 10 lakh divided by 16 lakh. It is 62.5%. After that, 1,80,000 divided by 16 lakh is 11.25%. And 80,000, 1,60,000. It is 5%. And 1,30,000 divided by 16 lakh. It is 8.13%. Now, 13,90,000 divided by 16 lakh. It is 86.88%. And 2,10,000 divided by 16 lakh. It is 13.12%. Then tax, 36,000 divided by, it is 2.25%. And now in the last, it is our 174 lakh divided by, it is 10.88% or 87%. So 87.5 it is. So I have written 88. So this is our common size statement of profit and loss. Now, in this answer, if you can see that our purchase of a stock in trade and change in inventory, if we combine these two, we calculate, you can say, the cost of material consumed or cost of goods sold. Okay.
Yes, sir.
Okay. Now, in first year, our cost of goods sold is 64.28% and 7.14%. That is 71.32%. So in first year, these two combined is 71.32%. But in second year, it is 73.75%. Okay. Now, the reason behind increase in cost of goods sold, can you tell me that why purchase of stock in trade value and change in inventory can be increased in 2 years in comparison with your sales? Yes.
So sales could have reduced, so the remaining closing inventory would have been more.
Actually, our sale is also increasing. In first year's sale is 14 lakh, in second year sale is 16 lakh. But the percentage increase in cost of goods sold is more than the sales. The reason behind this is either the cost of goods that we used in our product or the purchase price cost is increased. Yes.
Yes, sir.
Yes. And the second reason can be that our sale prices decreased. There is no change in quantity, only the price decrease. And in revenue from operation, no change in price label is mentioned. That's why we see the impact on percentage. Okay.
Okay, sir.
So by this method, by preparing common size statement, you can estimate that what is the reason behind change, and you can assume that there may be some price level change in sale price, or there may be increase or decrease in cost of goods sold. Same with the finance cost. In first year, finance cost is 5.71%, and in the second year, it is 5%. It means our finance cost is same in both the years, but our sale is increased. So there is no change in finance cost. Our sale is increased. That's why the percentage decrease. Okay.
Okay, sir.
In case of other expenses, our other expenses is increased in comparison with our sales. It is 6.43% in first year. It is 8.13% is second year. Now, this analysis is not required at the time of preparation of common size statement, but it can be asked in objective and in features of common size statement, or why we prepare common size statement. These kinds of question we have to answer like this. Okay.
Okay, sir.
Okay. Now, actually, in previous class, the yes, there is 3 points: the definition of common size statement, their objective, and the format. Okay, so this is the definition and objective of common size statement, and this is our format. Particular notebook, current year amount, previous year amount, current year common size percentage, previous year common size percentage, and there is formula: individual item into 100 divided by base item. Okay, I told you that which one is the base item in the statement of profit and loss and balance sheet.
So in profit and loss, it is revenue from operation, and in balance sheet, it is total of balance.
Yes, so it is written here in note. You can say this. So this is our common size statement. Now, do you have any doubt in common size statement or comparative statement?
No, sir.
Okay, so our chapter, the common size statement, is complete now. Analysis of financial statement. Now, which chapter? Actually, we have some chapter left in partnership. Yes.
Yes, sir.
Can you tell me which chapter actually we have completed up to which chapter in partnership?
So we completed the first 3 chapters.
First 3 chapter, that is change in profit sharing ratio.
Yes, sir, till there.
Okay, so we have not done our admission, retirement, death, and dissolution.
Yes, sir.
Okay, so now we will start admission of a new partner. Okay.
Yes, sir.
Yes, admission of a partner, or you can say admission of a new partner. Now, you know that partnership business can be started only with 2 or more persons. Yes.
Yes, sir.
Okay. So when we are running our business, we need some more person for our business. Okay, and the reason behind this is different. Okay, there can be many reasons behind admission of a new partner, that we need a new person in our partnership. Okay, can you assume, can you tell me any one of the reason behind admission of a new partner into the partnership firm?
Yes, sir. So when you
Okay.
need more capital, yes, sir.
Okay.
When you need some other person with some other skills which the current partners don't have.
What?
Business.
The knowledge?
Knowledge or skills which the current partners don't possess.
Okay. Okay, the reason behind this, you told me that additional capital. Yes.
Yes, sir.
And skills. Yes.
Yes, sir.
Is there any other reason? Okay. Actually, sometime we admit our manager in our business because he has some skills also. Yes.
Yes, sir.
Okay. Sometimes we don't need skills. We need some extra hand.
Yes, sir.
Okay. So extra. Now, all these requirements can be fulfilled by some other options. Like additional capital we need, we can go to bank and we will borrow some loan from bank. We need some extra skills, we will hire some people, we will employ some persons that have some specific skills. Yes.
Yes, sir.
And the third is we need extra hand, same we can hire employees. Now, so apart from these three options, why we will choose a new partner? Because when a new partner will come into business, he will share our profit. So profit will decrease. Yes or no?
Yes, sir.
So why we need a new partner? We can do this instead.
So they will also share the losses
They will
among
also
themselves.
share the losses. Yes, very good. Because if we take loan from bank, if we hire some employee, if we will obviously employ some persons, then they will not think about our profit or loss. Okay, whatever the situation is, we have to pay them interest or their salary. Yes.
Yes, sir.
Yes. So in case of partner, we are not uh, actually bound to give this interest or salary to person. If we have loss, we will not pay our partner. Same, uh, simple. Yes.
Yes, sir.
Okay. Now, if they are sharing our profit, then they are also sharing our loss. And in case of loss, okay, we don't want to pay any amount to bank as interest, or we don't want to pay any additional expenses, you can say, like salary to persons, interest on loan, or any other expenses like rent, electricity bill. In case of loss, we don't want to pay these things. Okay. So in case of partner, we don't have to pay such kind of fixed expenses, because fixed expenses generally increase your risk in the business. Now, can you tell me how it increases our risk? Okay. Actually, the reason that it increases our risk is, like in COVID times, there are many business which was shut down. Okay, the reason behind this shutdown is that their fixed expenses are high. There was no income. The sufficient income they don't have. Okay, and they have to pay these expenses. Okay,
Yes, sir.
so by every month their losses increased. Okay, their expenses was incurring every time, and there was no profit to pay them. So they have to pay their employee their interest from their capital, their, you can say, the saved money, retained earning, you can say. So for some time their retained money worked, and after that they have to use their capital, and after some time some of the business are not able to continue, so they have to shut down their business. Yes.
Yes, sir.
So this is the reason that our fixed expenses are a risk for our company. Okay, so that's why we need a new partner. So you understand that why we need a new partner.
Yes, sir.
Okay, is there any doubt in this?
No, sir.
Okay. In previous chapter of partnership, change in profit sharing ratio, I told you a term that we use here, reconstitution. Do you remember this? Reconstitution.
Yes, sir.
Can you tell me?
Sir, is reconstitution and revaluation the same?
No, revaluation is different.
Sir, I don't remember.
So you remember revaluation?
Yes, sir.
Yes, it is a type of adjustment in case of reconstitution. Okay, so reconstitution is a situation, is an event. Okay, and when this take place in the business, then we have to do some adjustment, and revaluation is one of them.
Okay, sir.
Okay, so reconstitution means change in relationship between partners. Actually, yes. Yes. You can see here that partnership is based on agreement. When there is any change in agreement between partners, it is called, you can see the screen?
Yes, sir.
Okay. So when there is any change in agreement between partners, it is called reconstitution of partnership. Okay. So I told you that if we are doing a partnership business, we have to prepare an agreement, a written agreement. Actually, it is not necessary, but generally we start our business with written agreement. Yes.
Yes, sir.
So if we want to change anything in that agreement, then we have to create a new agreement. We cannot overwrite on agreement and make any cuttings on the agreement. Okay, so we have to create a new one and then remove this agreement from the business. So it is like we are starting a new relationship, a new partnership business like this. Okay, so it is not like that we are shutting down our business. It is called only the change in relationship. And for that change take place, we have to change our agreement. That is called change in relationship between partners, and it is also called reconstitution of partnership. Okay.
Yes, sir.
Okay. So you can see here in this case, existing agreement between partners and a new agreement comes into effect. However, there is no effect on existence of form. So agreement is changing. The old one is removed from business and the new one comes into effect, but there is no effect on existence of form, means it will not change the situation of form. Okay, it is still operating. Now, some of the situation given here is change in profit sharing ratio, as I told you just now, admission of a new partner, retirement of a partner, and death. So these are the situation when a reconstitution take place. Okay.
Okay, sir.
There are some other situation also, but you don't have to study it here. Actually, there is a combination of two partnership form coming together to form a new partnership form. So in that case also reconstitution of partnership is required. Now, this is the adjustment. Yes, these are the adjustment required at the time of reconstitution of partnership. You can see here revaluation of assets and reassessment of liabilities is one of them. First is determining the new profit sharing ratio, calculation of sacrificing ratio, accounting treatment of goodwill, revaluation of assets, reassessment of liabilities, treatment of reserves, accumulated profit or loss, adjustment of capital. So these are the adjustment we have to do in this chapter. Now, first of all, when a new partner comes into business, like there is three partners, three existing partners into a business, and they are doing a business. Now there is a new person, sorry, D, who wants to join. Okay. Now this business is existing for 10 years. The life of this firm. And now D wants to join the firm. Okay. D will join with the permission of A, B, and C. Yes, we have studied this, that every person who wants to join a firm, who wants to join a running firm, have to take permission of all the partners. Okay.
Yes, sir.
So consent of A, B, and C each is required for admission of D. Now, if D wants to join, he can join the firm only with their agreement that A, B, and C agreed on the term that they will join, or there is something required for admission. Will A, B, and C will demand something from D to join the firm?
So should he give some kind of
Yes.
capital or collateral or something?
Capital or security, you are saying?
Yes, sir.
So when you are giving capital, then is there any requirement of collateral security?
No, sir.
Yes?
No, sir.
No. Okay. Yes, there is no collateral required if you are investing capital into the business. So for this, actually, we will study the calculation of capital, that how we will calculate the capital that is required to be brought by D. Okay. So A, B, and C will decide that. There can be some calculation, or they can say the random amount also. Okay, but generally it is not the random amount, because he will not agree on that term. Okay, he wants to join for a partnership. Okay, so he will pay the required amount, not like this, that the value of firm is 5 lakh and they ask him to bring 5 lakh into the firm. So it is not good for D. Okay, so he will not enough profit to for this investment. So that's why he will give only such amount which is required for ABC, or some extra, little bit extra. So A, B, and C will demand capital. Now, there is one more thing that they will ask from D, because let's say A, B, and C capital is given. It is 5 lakh, 3 lakh, and 2 lakh. Now, the total capital of A, B, and C is 10 lakh. Okay, but This is their starting capital. They have invested this total amount in the beginning. Now, can you tell me the total investment in the business will remain same, or the total assets, or you can say investment, will increase over the year?
It will increase.
Generally, it will increase, because if you have invested 10 lakh, after 10 years, it will not be the same, not be the 10 lakh only. Okay, it will increase. So let's say it increased now and become, after 10 years, it becomes 20 lakh. The total assets of the firm is now equals to 20 lakh. Okay.
Okay, sir.
Okay. Now, if we want to admit into the firm for 1/4 share, how much?
1/4 share.
So 1/4 share, if you see the capital, then as per this capital, he is required to brought only 10 lakh into 1/4, that is 2,50,000. Yes.
Yes, sir.
But then A, B, and C will say that what about our efforts that we have done for 10 years to establish this company? What about that? You don't have to pay. You will come and join the company without any additional payment. Yes, they will ask this or not?
Yes, sir.
Yes. So what do you think? How much amount we should pay as a capital?
So should we pay 1/4 from 20 lakhs?
1/4 of 20 lakh. Yes.
Yes, sir.
Actually, the capital payment will be equal to this, only 2,50,000. But the total payment he will pay is 5 lakh. 1/4 of 20 lakh. It is 5 lakh. Okay. And now this extra 2,50,000 is called goodwill. Okay.
Okay, sir.
He is bringing 2,50,000 as the proportionate of the capital of old partners, that is ABC, and he is also bringing 2,50,000 for the efforts made by A, B, and C. Now this will be kept in the form. This will be money of D. Okay.
Yes, sir.
When the business will shut down or business will closed, then this amount will be paid back to D. But this amount will be distributed between A, B, and C. They will take this as you can say compensation for their efforts. Okay.
Okay, sir.
Okay. So this is called goodwill. Now, why he is bringing two things? Actually, capital is brought by new partner for share in assets and liabilities. Okay. There is two things that a new partner receive in a new form: share in assets and liabilities. And the second thing is goodwill that he brought is for share in profit. Now, share in assets and liabilities he will receive by only joining the firm, but share in profit will be sacrificed by old partner. Yes.
Yes, sir.
Because they have to share, they have to decrease their profit share to give it to the new partner.
Yes, sir.
Yes. So if their profit share will be decreased, then in return, they will take something from D, that is called goodwill. Is this clear?
Yes, sir.
Okay. So that's why we need adjustment of goodwill also. So you can see after calculation of ratio, there is accounting treatment of goodwill. So if a new partner is taking profit share in the firm, then the profit share of old partner will also change. Yes.
Yes, sir.
Yes. So this is the adjustment. The third is revaluation of assets and reassessment of liabilities. I think you remember this.
Yes, sir.
Can you tell me?
So I don't know how to explain it.
Okay.
It's a
You don't know
revaluation
that
of,
what is the yes.
I know, sir, revaluation of assets is uh, calculating the assets after there's been change in it for over a period of time, and
Uh,
reassessment.
yes, it is same thing. Actually, the name is changed only. Revaluation is related to assets. Reassessment is related to liabilities. Okay.
Yes, sir.
Okay. So a revaluation means over the time, as you told me, that over the time there is some increase or decrease in value of assets. It doesn't remain same. Yes.
Yes, sir.
Generally, have you seen any increase or decrease in value of assets?
Recently.
Any assets and liabilities? Actually, you have seen some, but you don't remember right now. Maybe, but if you remember, please tell me
Yes.
any one change, increase or decrease in assets you have seen.
So, so when the land value increases after certain years.
Okay, yes, land value increases. Generally, the increase is always related to land or building, you can say. All the other assets price generally decreases.
Yes, sir.
So the land value increases because if you have purchased land at rupees 5 lakh, it will become after 5 years, it will become 10 lakh or 12 lakh like this. Okay. So this is in my area actually, the land value, the actually the measurement is called acre. Okay. You have seen this in measurement of land. Yes.
Yes, sir.
Okay. So it is like 8 lakh rupees per acre, but now it is very high. It is almost 30 lakh per acre. So this is how the land value increases. But uh, sometimes some of the value of assets decrease, like machinery. If you purchased a car 5 years from 5 years before, and the price of car is 5 lakh, then it will be around 2 or 3 lakh, right? Yes.
Yes, sir.
Yes. So over the time, the value of asset generally increases or decreases. Okay. But in case of liability, it doesn't happen. Okay. Generally, the liabilities remain same, because if you have to pay someone 50,000 or 1 lakh, it will not change.
Yes, sir.
Okay. Yes, there may be some interest uh, addition in that, but the amount payable, the principal amount will remain same. Yes,
Yes, sir.
yes. So that's why we value our assets and we want to know the value of liabilities. That's why it is called reassessment. We assess that is there any increase or decrease in liabilities, and we value our assets because there is certainty that there will be some increase or decrease in assets. Okay.
Okay, sir.
Okay. So we want to know the profit or loss on those increase and decrease in assets and liabilities. So that's why we do the revaluation. Next is treatment of reserves, accumulated profit or loss. So at the time of admission of a new partner, yes, at the time of admission of new partner, there is a retained earning or you can say reserve. Okay.
Yes, sir.
So there is a reserve of 5 lakh rupees. Now, if there is a reserve of 5 lakh rupees, can it be shared with new partner?
Sir, I don't know.
Okay. Generally, the reserve is related to past or future.
Pass.
Past. Okay. So when this reserve is created, when this is earned by the partners, then there was no new partner. Yes, only A, B,
Yes,
and
sir.
C.
Yes, sir.
So this should be distributed between A, B, and C only. There is no share of D in this profit because it is past profit. So it will be distributed between old partners.
Okay, sir.
But sometimes the old partners decide that it will not be closed. Actually, this is yes, always this profit will be distributed between old partners. Okay, but there are some situations that we will discuss when we will go in detail, when we will discuss this. Okay, so it is distributed between old partners. And the last one is capital adjustment. Now, what is adjustment of capital? I just told you in the beginning that when a new partner comes, the old partner will demand capital from them. Okay, and they will decide on certain basis. Yes.
Yes, sir.
But sometime they randomly told that you have to bring this amount as capital. Okay, and the new partner is coming into business and they see that his capital is more than the capital of old partner. So in that case, he can say that you have to make your capital also proportionate to my capital. Okay, a new partner can demand this. Okay, he has some rights because he is also paying the money. So he can say that if I'm paying 2 lakh rupees for 1/4 share, then the total capital should be 8 lakh. Okay, because I'm paying one share in 4 share. Okay, 2 lakh rupees. So total capital should be 6 lakh for all of you, all of the old partner. Okay.
Yes, sir.
So like this, I told you that A, B, and C here. Yes. D, a new partner is coming with 2 lakh capital for 1/4 share. Means in total 4 share, he's getting only 1. Okay. So total 4 share. So total capital should be 8 lakh. Yes.
Yes, sir.
Okay. Now 2 lakh is brought by D. So balance is 6 lakh, which is to be paid by A, B, and C.